topics and opinions expressed in the following show are solely those of the hosts and their guests and not those of W4CY Radio, its employees, or affiliates. We make no recommendations or endorsements for radio show programs, services, or products mentioned on air or on our web. No liability, explicit or implied, shall be extended to W4CY Radio or its employees or affiliates. Any questions or comments should be directed to those show hosts. Thank you for choosing W4CY Radio.
Welcome to the Ask Good Questions podcast, broadcasting live every Wednesday, 6 p.m. Eastern Time on W4CY Radio at W4CY.com. This week and every week, we will reach for a higher purpose in money and life, as well as a focus on health and wellness. Now, let's join your host, Bonita Bell-Andersen, as together we start with Asking Good Questions.
Hello, and thank you for joining the Ask Good Questions podcast. This is your host, Bonita Bell-Andersen, and today I have a very special episode just with me and my experience in the financial industry. We are going to talk about asking good questions around how to invest. And really, I'm going to talk to you about what my experience has been in my life and the big mistakes that people make. So let's bring up our slides and we'll get going with that. So we're really going to, I created something called the Ineffective Investor Loop, and we're going to go through and identify the things that people do when they're investing. A lot of times the reason that more investors aren't rich is because most people don't follow the rules in a way that allows them to play the game. So they play based on their emotions. This is all coming from a whole bunch of stuff that's been done around behavioral finance. People have the best intentions. They're trying to be responsible and do the right thing, but they make this investment decisions with their emotions. And that's a big mistake that puts them into what I call the ineffective investor loop. So if you've ever played sports and sometimes people will go off the rails with their emotions around something that's going on the field. So you know that you have to keep focused. You have to not let your emotions get the better of you. And it's the same with investing. So the circumstances are different, obviously, but the triggers that might cause you to lose it and make a bad move are there. So the ineffective investor loop is a vicious circle that drives people by their emotions to pull them off their game. So that graphic is showing you each step of this counterproductive whirlpool cycle, flushing your ability to develop and maintain a wise investment strategy. So these are the things we're going to talk about. And so we're going to go through this from 1 to 6, recognizing the need to invest. You then getting partial or poor quality information. You're then making investment purchases without a solid plan. And I'm talking about myself too, back in the day, especially after I went through a divorce and I was really just having to restart my life. Experiences around that made me very anxious. And so then if you're facing a market correction or a crash and you're experiencing losses and diminished confidence and getting out of things at the wrong time and locking in losses, well, those are all things that happen to people. And I know because I learned how not to do this. So let's go into the first one. So recognizing the need to invest doesn't necessarily mean that you're headed into the ineffective investor loop, but it's usually accompanied by a sense of insecurity and uncertainty about the future. So it's characterized by questions like, is there going to be enough money to maintain my standard of living now that I'm entered a new phase? Like in my case, I was restarting midlife and I was like, I was a mess. And I knew that I needed to totally reorganize my financial life. And I was like, how much do I need to save? How do I know what are the best investments? And so what happens is the media And the big investment companies, those advertisers want you to believe their slick marketing campaigns, which prey upon the desire for instant gratification, right? Or a fear of the future. And that's how they sell products. There's no credible evidence anyone has the expertise to reliably and consistently predict the direction of the market. You need to understand that. Or pick outperforming stocks, or select the next hot mutual fund manager, no matter what brokerage they work for. But many get so caught up in the feeling of wanting success that they fall for it, which is easy to do, right? So on the one hand, you desperately want to be successful, right? And you just totally want to have a successful investment portfolio. On the other hand, it's very easy to be manipulated by slick advertisements for investing tools that are sold by those who want to sell products. So all of this could lead to a lot of confusion about what to do. So those major life events often motivate individuals to begin investing. You know, like in my case, it was divorce. Sometimes it's losing a spouse. Sometimes it's a health challenge. I don't know. But setting clear financial objectives really encourages you to have a goal-oriented approach. And what I'm going to be doing is, through all these nightmare things that happen to people, I'm going to be talking to you about a globally diversified portfolio and coming at this from a team approach. So don't believe the market hype. The market trends and hype can trigger investment decisions that can lead to impulsive actions. I'm saying, don't do it. Many motivated investors, they do want to have that goal of accumulating wealth, right? But there's this thing called FOMO. Do you know what FOMO is? It's fear of missing out. Well, the fear of missing out can drive impulsive investment decisions, leading to short-term focus and risks. So I'm talking to you today about, I'm going to be, I'm telling you all the things not to do, but in the background, I'm going to be saying, learn about how to do a globally diversified approach and learn about being coached by an investor coach and have that discipline and long-term focus and awareness of personal motivations. All right. Those are the things that I'm going to be telling you again and again. So, you need to invest. Now, you might be getting partial or poor quality information. So one thing hasn't ever changed, and that is gathering information and educating yourself has usually been a good guide for making careful investment decisions. It wasn't until I really was serious about educating myself that I started turning my approach around. So, but that works to a point. The current information age, oh my goodness, has created access to so much information that it's easy to become overloaded with data. If you're new to investing, you may feel compelled to partake in all the information, read everything you can find on the internet and books, newspapers, magazines, on TV shows, advertisements, listen to friends' experiences, and so on before you make a move. Well, indeed, instead of reducing fears, this deluge of information often leads to intensifying an investor's confusion. It's difficult to wrap your head around comprehending the different options you see. There's advertisements, there's news, there's financial networks and shows, there's magazines, and the list goes on. Some of the sleazier ones will tell you that they can predict the future and help you become wildly successful in a very short amount of time. Don't fall for it. If someone could tell what is going to happen with inflation or long-term interest rates or share prices or overseas markets, they wouldn't be telling everybody out there. They'd keep it to a very elite few, or they might just keep it to themselves and be on some island somewhere. So everyone wishes they had a crystal ball to forecast the future, right? And we're often asked to believe that someone has the information or power or insight to do just that. But it's not the case. You may be swayed by stock managers whose predictions have outperformed the market the last little while, right? Those managers hope that just because they had some lucky picks maybe last year or maybe for the last 5 years, that doesn't have any correlation. There's studies on this. There's no correlation that that's going to continue in the future. When you look back at the actual data of different managers, their ability to repeat a great performance is dismal. So several studies have shown that time and again. Market pundits get it right far less than everyone would hope. So in fact, it's been noted that they sometimes get it worse than pure chance. Obsession with finding who's the best at predicting the future keeps everyone entertained, but it's still trying to predict the future. So do not fall for unverifiable online tips or biased advisors or the social media hype. That is what can lead to having major gaps in how your decisions will happen. Several years ago after my divorce, before I learned this crucial wisdom, I was attempting to be a day trader and pick stocks, and I was afraid of making mistakes. I was doing red light, green lights, arrows, options. I was trying a whole bunch of stuff, and I tried to forecast the future. I looked at gurus who happened to do well in the past, and I overloaded myself with new whiz-bang tools and information. Fortunately, when I had a big disaster one day, I said, you can't figure out what the market's going to do tomorrow. And I turned myself around and to discover and really look at what are the academic principles that drive the market. And look in the mirror. I just want you to look in the mirror. You can learn the principles needed to be a successful investor. But what I'm going to tell you is there is a globally diversified approach using a team that can make all the difference so that you can go about your life and do the things that you love to do. Just the sad truth is that investors get stuck in the cycle that take this bad information and go and buy some stocks, and then it just cycles through all the bad decisions. So confusion, misjudgment of risk tolerance is another topic that is important. You need to know what your risk tolerance is. You need to know how risky something is that you're getting into. And a lot of times there's missed opportunities. Poor information causes failure to identify and act on valuable opportunities timely. All right. So those common misconceptions and myths is quick profits. Don't fall for it. That leads to reckless and risky financial decisions. And when it's your money that you're talking about, you need to be prudent. The impact of hot tips can cause investors to engage in unsafe investment behavior. And I can't stress it enough, the importance of education. Education is just paramount and essential to avoid falling prey to these common misconceptions. Because I can tell you, after working with clients and having clients trust me for 25 years and being a trusted advisor, people look to you because they really don't have any idea how to go about this. So stage 3, we're going through this cycle of all these crazy things that happen. People will make an investment purchase without a solid plan. So here's some of the most common, biggest mistakes made when someone thinks they need to invest, but they really have no idea. These are the issues that come up when all you do is throw some money at the stock market and buy a bunch of stuff. In this stage, there are several potholes that investors fall into. They don't have a trading plan. There's no well-defined plan, no exact entry and exit points, no planned amount of capital to invest in the trade, no maximum loss they're willing to take. What they're doing is they're chasing after performance. What did well last year, the last 3 months or the last 6 months? That's nothing. You want to look at what's been happening in the last 20 years, what's been happening in the last 40 years. So, and you also have to think about being influenced by asset classes and strategies and managers and funds based on current strong performance. My experience in the past was that if something was good now, I should have invested in it 3 or 4 years ago. That cycle that led to this great performance may be nearing its end. And I was just like, oh my gosh, when I learned that, what's funny is that when I would buy something with my luck, it seemed to crash right after I bought it, right? I don't know, maybe you've seen the same thing, but there's a process and a concept called rebalancing. That is the process of returning your portfolio to your target investment plan, or how much risk you want to take. In this case, you're buying some stuff and then you're not selling it. It can be tough because that principle is about selling the asset class that is performing well and buying more of the worst performing asset class. And there's a whole bunch of asset classes. You shouldn't be involved in just one thing. You can end up all out of whack and have a situation with a portfolio that isn't performing well. So if you ignore risk aversion, this is the gal, maybe this gal, or the guy that doesn't look at her risk profile. And you go, what's a risk profile? Well, that's something that we can talk about later, but just realize it has to do with how cautious are you, how much of an adventurer are you, see how much money you could lose if things go wrong. Ask it. That's a good question to ask. Never invest more than you can afford to lose. Oh boy, was that a big thing that I learned in 2008 when I was in some real estate that went south. So don't forget your time horizon either. Are you young? Are you in your 20s and 30s and you have a long time horizon, or are you nearing retirement? You may be having to think about things in a different way. Think about if you need the funds you're locking up into an investment before entering any trades. Consider issues such as saving for retirement, a down payment on a home, or a college education for your child, right? Don't not pay attention. If you're thinking I'm just going to go out there and do this myself, there's something called stop loss orders. That's another lingo issue. This is where your stock goes down, and a stop loss means losses are capped before they become any more sizable than they might already be. A corollary to this common trading mistake is when a trader cancels a stop order on a losing trade just before it can be triggered because they believe, oh, I know it's going to go up. I know it's going to go up. Well, that's more stock market prediction issues. We do not want to be in the habit of predicting what the future is going to bring. So a lot of times, another thing is letting losses go. Out of control traders can become paralyzed if a trade goes against them. Rather than taking quick action to cap a loss, they hold on to a losing position in the hope that the trade will turn around. So this ties up your money for a long time, resulting in mounting losses and a big hole in your investment account. So impulse buying characteristics are driven by being emotional about this. And this behavioral finance field looks at how people react with money and how much their emotions make them do crazy things. So I keep harping on having a strategic investing approach because it means thorough research, it means risk assessment, it means alignment with personal financial goals. And what I propose is working with a team to help you get this really done well and plan out things based on what your goals for your life are and what your purpose for your life is. So emphasizing planning and strategy leads to improved financial outcomes and reduced risks. So social influence on investors is a huge problem, right? a lot of times, when you look at charts and things, sometimes there are things going on with companies that you just don't see. Sometimes stuff is going on that means the stock might not increase anytime soon. And it's hard to have a critical eye, as a low share price might be a false buy signal. And there's another thing called margin. There's many investors that have gotten themselves in trouble using borrowed money from their broker to purchase securities. This is can be such a big no-no, especially with futures and options. Your losses can be exaggerated in a hurry. So it can be easy to get carried away with what seems like free money. But what can happen is you end up with a large debt obligation for nothing. When you don't have the time or the knowledge to keep a close eye and make decisions about your positions, you can end up with your stock being sold to recover your losses. So another big thing is following the herd. Don't blindly follow the herd or investors you are talking to who are all excited about some hot stock. You may stay in a trade long after the smart money has moved out of it and jump right off the proverbial cliff, so to speak. I mean, when people are talking about one stock, I'm talking about buying the entire market, as Harry Markowitz said. I'm talking about being invested in 20,000 things, not one, because that is going to help you have a more measured, the ups and downs are more measured because you're in so many different things. So this whole thing with following the herd, when panic hits, it's likened to herd mentality when a herd stampedes over a cliff. That's what happened with 2008. Happened in 2000, 2001. It's one of the worst behavioral finance mistakes, and it plays out when you follow the investing crowd. Herding in investment occurs when you follow the group without doing any of this analysis and evaluation, right? So to avoid losing money in the markets, don't follow the crowd. And another thing, talking about one hot spot, the term keeping all your eggs in one basket? That's another way of saying overexposure to any one investment. That is the opposite of diversification. Ask anyone who worked for Enron or WorldCom, look them up and you can see what happened. People saw their entire investment or retirement account go away when those companies went out of business. Don't get emotionally invested in just one stock. Here I am again, I'm going to tell you again and again. Having a diversified portfolio made up of multiple investment products protects you if one of them loses money. So don't shirk your homework on this. Are you able to do your homework on seasonal trends? Can you approach this from a team approach and have a team helping you with doing the investing and talk to your advisor about the strategy that is being employed? So sometimes the urgency to make a trade often overwhelms the need for doing some research. But this may ultimately result in an expensive lesson, right? So I finally realized that, when I was facing a market crash, I was like, I can't do this anymore. I have got to figure out how I can make this work without me having to watch the market every moment of the day. So there's any of several factors that can trigger a correction. Disappointing earnings reports from a big company, bad economic news from abroad, tumultuous political events, but corrections are a natural part of the market cycle. Different research studies have shown that there's some kind of correction every 1 to 2 years. So whenever there is a market correction, some clients have called me because they're worried about the big declines and in a panic, wondering what they should do. I've had to actually do breathing exercises with people in the past, especially around the presidential elections, just worried that things are going to go into the dumpster. Well, we always review, and what I've always done in the past is we always review the investing principles, this whole thing with globally diversified, and the coaching we've done throughout all the market cycles. And I basically, one of the ways to look at it is that, I've talked people off the cliff to, it's okay, you're diversified, you're in this for the long term. And we talk about how investing done in this way was built for times like this, when it's rocky. Global diversification helps the investor to weather the storm. So remember that normal market corrections will cycle through, and it's going to be okay. Think long term, and hey, maybe turn off the news. So don't get caught in this ineffective investor loop. Don't be worried about failing to capture the returns you were hoping for because of mistakes driven by fear, overload, and guessing what you should do. Unfortunately, when people sell on a low and lock in their losses, they have given in to breaking the prudent, proven rules of investing. So when this happens, you for sure don't receive the rate of return that you so much wanted. And investor performance, which is your performance and how well you stuck to a proven system, right, does not equal investment performance, the performance of your portfolio. When this mistake is compounded by market corrections, or worse, big crashes, your investor potential for reaching your financial goals is significantly decreased. So my advice for inevitable market corrections that will occur throughout your investor lifetime is to do yourself a favor. Sit back, yawn, stretch when the market goes down, realize that your team is buying things on sale and they're selling those things that have outperformed. And you can check in with your team and talk about it. But knowing that you're well diversified knows that any one thing that's happening is not going to kill your portfolio. So be clear on your long-term goals so that you will stick to your plan. So remember, market ups and downs are natural parts of investing. Avoid panic. Understand volatility. What's that term? Volatility is kind of the ups and downs of the market. And understanding volatility will help you avoid panic and make rational decisions. And again, here I am saying, think long term, globally diversified, and maintain long-term focus. Recognize market volatility supports maintaining a long-term investment perspective and goals. So fear and anxiety can just do you in. It can cause impulsive decisions that, selling investments when they're at a loss, and don't do that. So the importance of emotional management can't be stressed enough. Managing emotions is essential to maintaining focus on long-term investment goals and avoiding rash decisions. So what we've seen in big crashes in the past is panic selling. Investors react by selling assets quickly, driven by fear and uncertainty. And some investors freeze and avoid making decisions, leading to missed opportunities and increased risk. I can tell you that the charts show that, like, after the big decline in 2008, it was about 3 years, but everything came back and the market went on and it recovered, and it always recovers. People don't listen to people that say, oh, it's never going to recover. Yes, it will. And because the market is made up of a lot of good companies. So don't let your emotions get in the way. Have effective coping strategies to improve decision-making and help you navigate financial turbulence with confidence. Okay? So stage 5 is losing money and that confidence. So if at this point the investor is completely frustrated and fearful of the future, this whole crazy cycle starts repeating. Selling during a market correction is what locks in those losses. You have now sold your stock at a loss, sometimes a big loss, and the end result is not enough money and no peace of mind, combined with worry and frustration and anxiety about the ability to accomplish all of your hard-fought goals for the future, right? So due to the way stocks are traded, you as an investor can lose quite a bit of money if you don't understand how fluctuating share prices affect your wealth. So in the simplest, I'm not going to name any companies, but just let's say that the price of a particular share is maybe worth 1,000 yesterday. And let's say something crazy happens and it drops 75% to be worth like 250. If you panic and sell the stock, you're going to receive back $250 for that $1,000 that you spent. That's not good money management, is it? So we don't know exactly when or if that is going to happen to any particular company, but what I'm trying to get across to you is to do a globally diversified approach with thousands and thousands of investments instead of one or two. So if you haven't panicked and you have left the money in the investment portfolio, there's a good chance that the losses are going to be recouped when the market rebounds, because you can see it. You can look at like the last 100 years and you can see how the market has rebounded. Remember though, there's no guarantees. I'm just giving you good concepts today. So with the stock market's penchant for producing large gains and large losses, there's no shortage of faulty advice and rational decision-making. As an individual investor, the best thing you can do to manage your portfolio for the long term is to implement a rational investment strategy. And that's what we do with our clients. So you need to be comfortable with it and willing to stick to it. Remember, if you're looking to make a big win by betting your money on your gut feelings, maybe try a casino, because that's what this is. You are gambling. When you have no idea what you're doing, you are gambling with your money. Take pride in your investment decisions, and in the long run, your portfolio has the potential to grow to reflect the soundness of your actions. So stress is not good. Regret and decisions that you've made a mistake, that's not good. And loss aversion leads to overly cautious or reactive investors. So think about the impact. It leads you to exit markets prematurely. You want to focus on building resilience. Recognize the confidence loss that you may experience if something like this happens. So you need to build resilience to the market. So if you turn yourself around and say, I'm going to learn how to buy the market and how to have a global approach to this, and that will help you with your emotions to build resilience and learn from setbacks. Okay, stage 6. So exiting investments and locking in losses. Did you know there's a company called Dalbar? Dalbar regularly does studies on investor behavior. And those studies show that investors are their own worst enemy. So this has happened many, many times where, for instance, it'll show that the average investor earns 3.98% annually, whereas if they had just stayed in, they would have done much better. And at the same period of time, it'll show the S&P 500 like at about 10%. This happens again and again, no matter which time period you are looking at. These returns have been roughly the same every time. And so you could look at those numbers in any time period, and my guess is that you would find the same data. It's just the truth. And so the reasons are simple. Investors try to outsmart the market, right? And they practice frequent buying and selling in an attempt to make superior gains. So to avoid losing money in the markets, tune out the outlandish investment pitches and the promise of riches. As in the fable of the tortoise and the hare, a slow and steady approach is going to win out. Avoid the glamorous, can't-miss pitches and strategies, and instead stick with proven investment tracks for the long term. Avoid any short-term market dips and stay out of the ineffective investor loop. So ultimately, the slow and steady approach is going to win the financial race. Just remember the fact that these cycles repeat. So people will get a sense of FOMO. Remember that fear of missing out? And they get back in and repeat the cycle. They'll go around and around and around. And because we carry our cell phones with us now all the time, this constant access to social media has expanded the impact of FOMO on investment strategies. Through many cycles in the past, the internet has made sure we are aware that large cap indexes like the S&P 500 and the Dow Jones Industrial Average and the NASDAQ are at all-time highs in achieving super wonderful returns. And we wonder why our more diversified portfolio isn't behaving in a similar way. What you don't know is if you're focused just on the US, you're going to miss out on all the wonderful things that are happening all around the world with all these different companies in different categories. And that is the truth. There's the US, it's about 50% of what's available to invest in the US. So you may think it's hard to be content with a diversified strategy when every media outlet is constantly reminding you how you're missing out on the stellar performance that could be obtained if only you had a non-diversified portfolio. Like maybe you should own, if you only did large US stocks, you are missing out on so much. I'm just telling you. So when it comes to investing, FOMO, or the fear of missing out, is significantly impacting the thing called recency bias. That's the tendency to think that trends and patterns we observe in the recent past will continue in the future. Our fear of missing out becomes more and more intense after the market has just experienced an uptick. So if we take a couple of steps back, it's clear why we maintain a diversified portfolio. It provides the best trade-off between maximizing returns and minimizing risk. And this, again, has been shown again and again. We use academic global principles to do investing all over the world. So it's hard when it seems like all your friends are taking advantage of the latest market trends and you're missing out. But of course, changing your portfolio to try and take advantage of a run that has already taken place would be foolish. And hopefully you can see that. So you would be selling assets with prices that have remained flat and may now be undervalued relative to the market. So a lot of these things are things that can happen because of fear of missing out. And you would be wise to avoid this type of thinking. We have been in this position before. In the late 1990s, people wanted to abandon their diversified portfolio and put a heavy focus on the technology stocks that were making all their neighbors rich. Well, it was, that about 2000, 2001, and everything crashed. And then in the mid 2000s, everyone wanted to borrow as much money as possible and get into the funds to buy and flip real estate. I got caught up in that, and I got taken to the cleaners when 2008 happened. So early 2010s, 2010, 2011, 2012, everyone was wondering if they should sell their stocks before a double dip recession began. So in each of these scenarios, we're hearing individual stories of others who have implemented these strategies and were doing better than we were. Remember that fear can influence decisions. You have a need for liquidity, and you can lose your confidence because of making these mistakes that you don't know how to fix. Selling at a loss stops investors from benefiting from potential market recoveries and future gains. That is huge. And locking in losses can cause regret and promote poor investment habits. So, how do you break the cycle? Again, I'm going to tell you, that's why I'm here. I provide a lot of financial education as well as health and wellness topics. Learn financial concepts from your investor coach to make informed decisions. Plan, have clear investment goals and plans. Control your emotions and consult a trusted financial expert. I hope that it's me and my team. What I'm going to offer you is a free consult with one of our team to set up taking a look at how you're doing this. But however you do it, seek reliable advice. So, in conclusion, it's impossible to give specific recommendations here on what you should buy when it comes to the stock market. I'm just giving you broad strokes. Buy a globally, have a globally diversified account. I don't believe you can do that well as an individual. That's why we have a team approach. And you can minimize risk by spreading your investments across a diversified portfolio. And the easiest way to think about this is to buy the entire market, like Harry Markowitz said. And again, there's a lot of studies that show that diversification can be a huge part of success in a portfolio. So investors have the challenge of emotional challenges and pitfalls that often hinder their success. You need to identify if you're doing any of this cycle of the ineffective investor portfolio where you're doing these things and going through this destructive cycle. You need to identify it yourself and improve decision making. And the most important thing is adopting discipline. I can't tell you enough. You need to have discipline in this because there's so many things that want to pull you off track. So we invite you to consult with one of our investor coaches to discuss your personal situation and explore developing a globally diversified portfolio and how you would do that. The easiest way to do that, I felt, was just to email me to set that up, and I can let you know how we can get that set up so that we can have a chat with you and see how best to help you. So these values are at the heart of all your financial decisions, whether you're aware of it or not. And once you identify them, your values can serve as a compass to help you consistently focus in the right direction. I can tell you that the company that I work with, 10Cap Wealth Coaching, it's a registered investment advisory firm. It's independent and is founded on the academic, globally diversified investment principles that are supported by Nobel Prize winning research and philosophies. We work in a fiduciary capacity with all of our clients. So when you integrate your goals and your values into how you're going to use your money, you're going to begin to discover what's important for you and what your purpose in life might involve and where this money fits in, because money's great, but what's important is your purpose, and what's important is how best to live your life and have satisfaction from all areas of your life. And with that, I invite you to email me at bonita@10cap.com, and we can discuss your situation and let you know how we do things and how we support this type of approach with doing a diversified portfolio. With that, thank you so much for joining us on Ask Good Questions, and we'll see you next time.
Today's episode is over, but we did ask good questions again, didn't we? Don't miss out as we broadcast live every Wednesday, 6 p.m. Eastern Time on W4CY Radio at W4CY.com. Join Bonita Bell-Andersen next week for more conversations with experts on finances, retirement, behavioral finance issues, health and wellness, and more. Until then, remember to ask good questions.